Silver is ripping higher, and a rumor is spreading that someone is about to ban you from buying it. If that is true, everything changes. If it is false, the rumor still matters, because in a market like silver, belief can trigger the same chain reaction as reality. That is what makes this moment dangerous. Not because a shadowy hand is guaranteed to step in, but because the crowd is primed to react as if it already has. Let me say this plainly before we go further. This is education and storytelling. It is not personal financial advice. I cannot know your situation, your risk tolerance, or how you are exposed. What I can do is walk you through what is real, what is not, and what you can measure so you do not get dragged around by fear disguised as certainty. Now take a breath and picture the scene that is playing on countless screens. A dramatic headline. Words like emergency, words like meeting, words like crackdown, words like ban, and a timer in your mind counting down to some invisible deadline. This is how the rumor wins. It does not win by being proven. It wins by creating urgency. Because urgency makes you skip steps. Urgency makes you trade the comfort of a story for the discipline of verification. So we are going to do the one thing the rumor does not want you to do. We are going to slow down and audit it. Here is the first question that matters. Who exactly could ban silver buying? The rumor usually does not say it implies a single authority, a single switch, a single moment when access is removed. That is the first red flag. The silver market is not one switch. It is a system of switches. It is physical metal in the real world and paper exposure in financial markets and a huge gray zone in between. When people say buying silver, they might mean walking into a shop and purchasing a coin. They might mean ordering a bar online. They might mean buying shares in a fund that claims to be backed by metal. They might mean trading futures contracts. They might mean buying options. They might mean holding a leveraged product that moves with the price. Those are not the same action, and they are not controlled by the same rules. So the rumor begins by collapsing everything into one scary sentence. Banning silver buying. It sounds simple. It is not. Let us separate the world into two rooms. In the first room is physical silver, real bars, real coins, real industrial feeds, real inventory. In this room, restrictions would look like something you would recognize in the real economy. Dealers raising premiums, dealers limiting quantities, wholesalers delaying shipments, refineries running at capacity, logistics, bottlenecks, payment processors tightening terms. Insurance costs rising. None of that requires a regulator to declare a ban. It happens when demand surges and supply chains strain. In the second room is paper silver contracts, claims, exposure, futures, and options on an exchange. Over-the-counter agreements between institutions, shares in a vehicle that trades like a stock. In this room, what feels like a ban is often just risk control. Higher margin, tighter credit, wider spreads, lower leverage, brokers restricting certain orders. That can happen fast. And to a leverage trader, it can feel exactly like the door has been slammed shut. Now we introduce the cast of characters because this is where the rumor dies or becomes real. There is the regulator that oversees certain derivatives markets. There is the exchange that operates the marketplace where contracts trade. There are brokers who decide how much risk they will carry for clients. There are clearinghouses that stand behind trades and demand collateral. There are market makers who provide liquidity until they do not. Each of these actors can change your experience of the market without any one of them announcing a ban. So when you hear ban, translate it into a more precise question. Which actor is supposedly doing what in which room, through which mechanism, and how would it show up? Now, here is the uncomfortable truth. In silver, you do not need an actual ban to get ban-like outcomes. All you need is volatility, meeting leverage. Imagine you are holding a futures position, you put up collateral, and you control exposure that is much larger than your cash. When the market becomes more volatile, the exchange raises the required collateral. Your broker passes that requirement to you, sometimes with extra cushion. Suddenly you need more capital to hold the same position. If you do not have it, you must reduce. If many people must reduce at the same time, price drops. And that drop triggers even more reductions. That is a liquidation cascade. Nobody banned buying. But for many participants, the experience is identical. They are forced out. This is why silver rumors often bloom during extreme rallies. The market is stretched. Excitement rises. More people enter with leverage. And leverage is a fragile form of confidence. It looks strong on the way up. It collapses on the way down. Now we are going to audit the rumor the way a prosecutor would, not with anger, but with receipts. Most of these rumors point to a meeting. Sometimes it is described as a closed meeting. Sometimes it is described as emergency. Sometimes it is pinned to a specific time. And the implication is that the meeting is about silver and that the outcome will be restrictions. Here is what you need to know about meetings in government and regulation. There are many meetings all the time. Some are public. Some are closed. A closed meeting does not automatically mean a dramatic action is coming. Closed meetings can be routine. They can involve enforcement matters. They can involve personnel. They can involve litigation. They can involve confidential market oversight. They can be scheduled and rescheduled. They can appear ominous to someone scanning for confirmation. This is where rumor mechanics become almost elegant in their cruelty. The internet does not need to invent a meeting. It only needs to misinterpret one. It only needs to swap an agency name and a screenshot. It only needs to take an ordinary notice and frame it as a plot. And because you are already watching silver rocket upward, your brain accepts the frame because it matches the emotional weather. So instead of chasing screenshots, we ask a calm question. What would a real targeted restriction actually look like? And where would it be documented? If a regulator were going to impose a broad ban on buying silver, it would not happen quietly. It would be extraordinary. It would raise legal questions. It would trigger headlines in mainstream financial media. It would likely involve formal statements, rulemaking, emergency orders, and immediate market guidance. It would also be difficult to implement in the physical room because physical silver is a global commodity traded across jurisdictions through countless private actors. But if the concern is not a literal ban, if the concern is the market becoming harder to participate in, then the likely mechanism is far more mundane and far more common. Margin changes, risk limits, credit tightening, and this is where we shift from rumor to the part you can actually use. Because the real question is not, will a mythical ban happen? The real question is what happens to your exposure when the market enters a risk control phase. In other words, what happens when the ecosystem decides the ride is getting too wild? Let us talk about the exchange for a moment in plain language. An exchange runs the contract marketplace. It wants liquidity, but it also wants survival. When volatility rises, the exchange and the clearing system protect themselves by demanding more collateral from participants. They call this performance bond or margin. It is not a punishment. It is a seatbelt. The problem is that seatbelts change driver behavior. When the seatbelt suddenly tightens, people stop accelerating. Some people get thrown forward. And in a leveraged market, some people are forced to exit. This is why in a hot silver market, a margin increase can be more powerful than any rumor. The rumor spreads fear. The margin increase creates mechanical selling. Now, consider the broker. Your broker is not a charity. Your broker is a risk manager with a user interface. If the broker thinks the market is too volatile, it can raise house margin. It can limit order types. It can restrict new positions. It can reduce leverage. Again, none of this is a ban on buying silver as a human being, but it can feel like access is being removed, especially if you are using leverage. Now, consider the clearinghouse. The clearinghouse is the invisible spine. It guarantees settlement. It is the reason markets can function at scale without every participant worrying about the creditworthiness of every counterparty. But the clearinghouse only guarantees if collateral is adequate. So it demands collateral. And when it demands more, participants either post it or reduce risk. You are starting to see the pattern. The rumor describes a dramatic switch. The reality is a series of dials being turned tighter in response to volatility. Now let us return to silver itself, because this is where the story becomes cinematic. Silver is not only a price. Silver is a chain of custody across the planet. It is metal in vaults, metal in transit, metal in industrial inventories, metal in retail products, metal in bars that meet certain standards, metal in bars that do not. It is metal in one city that is not easily moved to another without time, cost, and paperwork. When silver rallies, the chain tightens. Everyone who touches silver feels it. The industrial buyer worries about input costs. The dealer worries about replacement inventory. The wholesaler worries about shipment schedules. The trader worries about margin. The fund worries about flows. And then in the middle of this, the rumor arrives and says, someone is about to shut the whole thing down. That rumor feels plausible because the market already feels strained. So we ask a deeper question. Why does the rumor appear now? The answer is that rumors are often a symptom of stress. When markets move calmly, people do not invent conspiracies to explain them. When markets become violent, people reach for an authority figure to blame because randomness is frightening. A story about a ban makes the chaos feel organized. It gives your brain a villain. And when your brain has a villain, it stops asking hard questions. But we are going to keep asking. Here is the first hard question. What is the difference between a ban and a limit? A ban is a prohibition. It says you may not do this. A limit is a risk control. It says you may do this, but only under certain conditions, with certain collateral, within certain size. Most of what people experience as banned is actually limited. This matters because if you are building a strategy around the idea that a ban is coming, you might make decisions that are irrational in the real world. You might panic buy at the worst time. You might over-leverage. You might refuse to take profit because you believe access will disappear. You might become emotionally attached to the rumor because it justifies your risk. That is how people get hurt. So we replace the rumor with a map. In the physical room, the biggest risk is premium expansion and supply delays. Even if the spot price falls, Retail premiums can remain high if supply is constrained. That means the experience of buying and selling physical metal can diverge from the headline price. The rumor of a ban can also drive a rush into physical products, which tightens availability and increases premiums, creating a self-fulfilling cycle of scarcity feelings. In the paper room, the biggest risk is forced liquidation during volatility. When margin rises, leverage shrinks. When leverage shrinks, crowded trades unwind. When crowded trades unwind, price can fall sharply. After that, if the underlying thesis is strong, the market can rebuild. But the path is brutal, so the question becomes, what kind of participant are you, and which room are you in? If you are in physical, your enemy is not a meeting. Your enemy is liquidity and friction. You might be able to buy, but at a painful premium. You might be able to sell, but at a painful spread. Your timeline matters. Your storage matters. Your trust in counterparties matters. If you are in paper, your enemy is not a meeting. Your enemy is leverage and volatility. Your timeline matters. Your margin buffer matters. Your risk management matters. Now, you might still ask, could a regulator impose position limits that restrict certain market behavior? Yes, position limits exist. They are designed to prevent excessive concentration, especially in the near-term delivery window, where the relationship between open interest and deliverable supply can create squeeze conditions. But position limits are not a ban on buying. They constrain size and behavior at certain thresholds. They affect large participants more than small ones. They are a part of market structure. The rumor often takes something like position limits and translates it into a dramatic phrase that triggers retail panic. Banning silver buying, it is a distortion. Now we need to address the most emotionally charged version of the rumor. The version that says, you have a short window, a countdown, a last chance. This is the oldest marketing spell in finance. It is not always false, but it is always suspect. Real markets do not hand you cinematic deadlines on a platter. Real markets create deadlines through margin calls, through liquidity shifts, through volatility spikes, through price gaps. The deadline is not a date on a meme. The deadline is the moment your risk becomes unmanageable. So instead of counting down to a meeting, we build a 3-dial dashboard you can watch any day. The first dial is official communication, not screenshots, not hearsay. Official notices, exchange advisories, rule filings, broker bulletins. If you see a real change, it will be written somewhere in plain language, because the system cannot function if participants do not know the rules. The market runs on documentation. The second dial is volatility. Volatility is the market pricing turbulence. When volatility rises, risk controls tighten. When risk controls tighten, leverage shrinks. When leverage shrinks, price becomes more sensitive. If you want to anticipate the feeling of a ban, watch volatility, because volatility is the pressure that causes the system to clamp down. The third dial is the divergence between physical tightness and paper excitement. When paper price runs while physical indicators cool, that suggests speculation is leading. When physical tightness remains stubborn, that suggests the rally has a firmer foundation. This dial is not perfect, but it keeps you honest. Now, let us tell the story. The rumor is trying to hide the story of how a market turns against the crowd. It begins with a rally. The rally feels justified. Maybe it is. People buy. The price rises. Early buyers feel smart. The narrative spreads. Late buyers arrive. The late buyers are often more emotional because they are fighting regret. They do not want to miss it. They buy with less patience. Some of them buy with leverage because the gains look easy. Then the market experiences a jolt. It could be a stronger currency move. It could be a change in interest rate expectations. It could be a large sell order from an institution taking profit. It could be a margin adjustment. It could be nothing more than exhaustion. But the price dips. In a normal market, a dip is a dip. In a leveraged market, a dip is a margin event. Some participants must reduce. They are selling pushes price further down. That triggers more reductions. Liquidity providers widen spreads because they sense disorder. Now the market begins to fall faster than the original news would justify. At this moment, the rumor appears or intensifies. People need an explanation that matches the pain. They do not want to believe they are experiencing a normal unwind. They want a villain. They want a ban. And the rumor gives them a villain. This is how the rumor and the unwind feed each other. The rumor creates panic. Panic creates selling. Selling creates price drops. Price drops create more rumor. If you want to survive silver, you must recognize this loop when it begins. You do not need to win an argument online. You need to protect your mind and your capital. Now, let us talk about the difference between a real squeeze and a social media squeeze. A real squeeze has fingerprints. It shows up in persistent dislocations. It shows up in urgent demand for deliverable metal in specific channels. It shows up in borrowing costs, in near-term spreads, in unusual regional premiums, in inventory movements. It can last longer than you expect because it is constrained by logistics. A social media squeeze is mostly a story. It can still move price because stories move money, but it is more dependent on flow than on structure. It often burns bright and then fades, leaving people holding exposure they did not plan to hold. The rumor of a ban often emerges when people are trying to convert a social media squeeze into a real squeeze. They want to make the story feel inevitable. They want to force urgency. But markets do not run on inevitability. They run on collateral. So here's a thought experiment. Imagine tomorrow morning you wake up and there is no news, no meeting, no ban, nothing. But volatility is up and the exchange raises margin. Would that change your life if you are leveraged? Yes. Would you feel like buying has become harder? Yes. Would you possibly be forced to sell? Yes. Now imagine the opposite. Imagine there is a meeting notice somewhere that looks scary, but margins do not change. Volatility stays calm, liquidity stays healthy, and physical indicators show no stress. Would that meeting ruin you? Probably not. It might become a headline, but the market would not have mechanical pressure. This is why the dashboard matters. It separates narrative threat from structural threat. Now let us go deeper into the anatomy of a margin event, because this is where the most practical value lives. Margin is collateral. It is the money you must post to hold a position. The exchange sets baseline requirements and brokers can add their own. When volatility rises, the probability of large price swings rises, and the exchange increases margin to protect the system from default. This can happen quickly. It can happen in response to recent volatility, but it can also happen in anticipation of expected volatility. And when it happens, the market can move before you even fully understand why, because participants react instantly. If you are holding a large position with a thin buffer, a margin increase is like the floor rising toward you. You have less room. If you cannot post more collateral, you reduce the position. If thousands of participants reduced at the same time, the market drops. That drop triggers stop losses and further liquidation. That is how a normal risk control becomes a violent price move. Notice what is absent: a ban, a meeting, a conspiracy. The mechanics are enough. Now, could a regulator influence this environment indirectly? Yes. Regulators can pressure for orderly markets. They can scrutinize manipulation. They can set frameworks for limits. They can bring enforcement actions. These are real powers, but they rarely translate into the dramatic phrase band buying. They translate into rules, filings, and cases. So when you see a rumor that uses a simplistic phrase for a complex system, your skepticism should rise. Not because you want to be contrarian, but because simplification is the tool of manipulation. Now, let us address another angle that the rumor often uses: the idea that authorities want to stop silver because silver exposes something about money. This is emotionally compelling. It is also not necessary to explain what you are seeing. Silver is volatile because it is small compared to the amount of financial attention it can attract. And because it sits between monetary demand and industrial demand, it does not need a villain to be dangerous. It is dangerous on its own. That said, it is true that exchanges and brokers do not like disorderly markets. They do not like moves that threaten settlement. They do not like crowds using leverage in a thin market. Their response is risk management, and risk management can feel like suppression if you are on the wrong side of it. So if your goal is to stay rational, replace the word suppression with the word collateral. Replace the word bandwidth, the word margin. Replace the word crackdown with the word volatility. This translation will keep you sane. Now we bring the story back to the viewer, because this is not a courtroom. It is your life. If you are watching this because you hold silver and you fear you will not be able to buy more later, ask yourself why you feel that urgency. Is it because your thesis is long-term and you are calmly building exposure? Or is it because price is running and you feel regret? Regret is not a signal. Regret is a feeling. Markets feed on it. If you are watching this because you are leveraged and you fear a sudden rule change, ask yourself a more useful question. How much margin buffer do you have if volatility rises? How quickly could you reduce without becoming a forced seller? If you cannot answer those questions, the rumor is not the problem. The leverage is, if you are watching this because you want to buy a physical metal, ask yourself what the real constraints are. Premiums, availability, delivery, CHIMI, counterparty trust, those are not controlled by a meeting. They are controlled by supply chains and demand waves. Now, Let us make the investigation concrete with a simple narrative reconstruction of how these rumors typically start. Someone posts a claim. It includes a specific time. That time makes it feel official. The post includes the name of an agency. That name makes it feel credible. The post includes the word emergency. That word makes it feel urgent. Then the post spreads through communities that already believe authorities will intervene. Every share is not proof. It is reinforcement. Then people start looking for confirmation. They find a meeting notice from some agency. They see the words closed meeting. Their brain treats it as confirmation. They do not check whether it is the same agency. They do not check whether the agenda is related. They do not check whether the meeting is routine. They simply feel relief because the rumor now feels anchored to a real document. At this stage, the rumor becomes harder to kill because it has a receipt, even if the receipt is irrelevant. Then someone adds a claim about the exchange. Someone says margins will be raised. That is plausible because margins do get raised in volatile markets. So even if the meeting claim is wrong, the margin claim can become true, and the rumor survives. This is how misinformation evolves. It mutates toward plausibility. So the correct response is not to argue about a screenshot. The correct response is to monitor the dials. Now, let us build the 3-dial dashboard into a calm mental habit. The first dial, documentation, is about official communication. If you see a claim, your first question should be, where is it written in an official channel? If it is not written, treat it as a hypothesis, not a fact. If you cannot verify, do not build a high-risk decision around it. The second dial, volatility, is about the market pricing turbulence. If volatility is rising, risk controls are more likely. If volatility is falling while price holds, the market is becoming healthier. This dial is the bridge between narrative and mechanics. The third dial, physical versus paper, is about confirmation. If price is rising but physical tightness indicators are not confirming, be cautious about interpreting the move as inevitable. If physical tightness is obvious and persistent, be cautious in a different way because squeezes can create both opportunity and danger. Now, we are going to address a paradox that confuses many people. Why does the system tighten risk controls when the market is rising? Should it not tighten when the market is falling? The system tightens when risk is high, not when direction is down. A vertical rise is risk. It increases the probability of a violent reversal. It increases the probability that someone defaults. It increases the probability that settlement becomes stressed. So the system tightens into the rally, not to stop it, but to prevent it from breaking the plumbing. This is another reason the rumor feels believable. People see tightening and assume it is targeted suppression. But in many cases, it is a standard response to elevated risk. Now, let us talk about why silver is uniquely vulnerable to these dynamics. Silver is smaller than major equity markets. It is smaller than the bond market. It is smaller than many commodity complexes when measured by total liquidity and depth. But it can attract enormous attention during moments of fear or excitement. That mismatch creates violent moves. Silver also has dual identity. It is a precious metal and an industrial metal. That means it can rally on monetary narratives and on industrial narratives. When both align, the rally can be explosive. But it also means silver can be hit from multiple angles when conditions change. A stronger currency can hurt. A slowdown in manufacturing can hurt. A rise in real yields can hurt. A collapse in speculative appetite can hurt. Silver can be pulled down by forces that do not always affect gold in the same way. This dual identity is why silver rumors carry more emotional charge. People project onto silver. They treat it like a referendum on the entire system. That projection increases the power of fear-based narratives. Now we are going to do something that makes rumor proofing much easier. We are going to define what a real restriction would look like in each room. In the physical room, a real restriction would look like formal rationing by sellers. Not because they want to ban you, but because they cannot source supply fast enough. It would look like consistently higher premiums and limited inventory. It would look like longer delivery times. It would look like large buyers locking in contracts. It would look like refineries and wholesalers controlling allocation. In the paper room, a real restriction would look like a change in trading rules that is explicitly published, such as altered margin requirements, adjusted position limits, or changes to settlement procedures. It would look like broker notices changing leverage or order permissions. It would show up in the mechanics. Notice the theme in both rooms. Reality is documented and observable. It is not hidden behind a rumor. So the best antidote to the rumor is not a debunking thread. The antidote is a habit of observation. Now, we are going to close the loop by answering the question you actually care about. What should you do with this information? You do not need to do anything dramatic. You need to become harder to stampede. If you hold silver exposure, understand your vulnerability to margin and volatility. If you are in physical metal, understand your vulnerability to spreads and premiums. If you are in paper exposure, understand your vulnerability to forced liquidation. If you are considering entering, understand that late entries in a vertical market require emotional discipline. You must be able to tolerate pullbacks without panicking. And if you are listening to a rumor that tells you the world will end in a few hours unless you act, treat that as a warning sign about the messenger, not about the market. Because the market does not need a ban to hurt you. The market only needs you to act without a plan. Now here is the final synthesis, spoken as simply as possible. A banned story is a narrative. Risk controls are mechanics. In silver, mechanics matter more than narrative, but narrative can trigger the behaviors that make mechanics bite harder. So if you want to stay safe, watch documentation, watch volatility, watch physical confirmation, and watch your own urgency. The moment you feel rushed is the moment you should slow down. Silver will still be here tomorrow. The real question is whether your capital and your clarity will still be here with it. I cannot fit the full requested length in one message here. If you reply continue, I will paste the next block in the same pure text style. Flowing directly from this ending line without headings, timestamps, numbering, citations, or formatting